Equity portfolios generate income from several sources beyond simple price appreciation. The most common source is dividend income, which consists of cash distributions paid by companies to shareholders from profits or excess cash flows. Well-established firms often provide regular dividends, making them attractive to investors seeking current income. Additional sources of portfolio income include securities lending, where portfolio holdings are temporarily lent to other market participants in exchange for fees, and the reinvestment of cash collateral received from borrowers. Portfolio managers may also generate income through option writing strategies, earning option premiums while maintaining ownership of the underlying securities. Some managers employ dividend capture strategies to enhance income generation. These techniques can contribute meaningfully to total portfolio return when implemented effectively. While income opportunities can enhance returns, investors must carefully evaluate the costs associated with managing equity portfolios. Management fees represent the most visible expense and may consist of fixed fees, performance-based fees, or a combination of both. Some managers bundle all services into a single fee, whereas others charge separately for specialized services or utilize third-party providers. Beyond management fees, transaction and trading costs significantly influence net performance. Explicit costs include commissions, taxes, and exchange fees, while implicit costs include bid-ask spreads and market impact costs. Active investment strategies generally incur higher costs because they require more frequent trading, extensive research, and ongoing portfolio adjustments. Understanding total portfolio costs is therefore critical when evaluating investment effectiveness. Shareholder engagement has become an increasingly important component of modern equity portfolio management. Shareholder engagement refers to actions undertaken by investors to influence corporate behavior and governance practices. These activities may involve direct discussions with management, participation in shareholder meetings, proxy voting, or collaborative initiatives with other investors. The objective is to encourage management decisions that enhance long-term shareholder value while addressing environmental, social, governance, or strategic concerns. Effective engagement can improve corporate transparency, strengthen governance structures, mitigate operational risks, and support sustainable business practices. Because institutional investors often hold significant ownership stakes, they possess the influence necessary to encourage meaningful changes that benefit both shareholders and broader stakeholder groups over time. Even investors who do not actively participate in engagement activities may benefit from the efforts of others. Successful shareholder engagement can improve company performance, reduce agency conflicts, and promote better alignment between management and shareholder interests. Enhanced governance practices may lower operational risks, improve capital allocation decisions, and strengthen long-term profitability. However, engagement is not without challenges. It requires significant resources, expertise, and time commitments from portfolio managers. Furthermore, engagement outcomes are uncertain because management may resist proposed changes or external factors may limit the effectiveness of shareholder influence. Investors must therefore assess whether the expected benefits justify the associated costs and resource requirements. The effectiveness of engagement often depends on ownership concentration, corporate responsiveness, and regulatory environments. Equity portfolio management exists along a spectrum ranging from passive to active approaches. Passive management seeks to replicate the performance of a specified benchmark through minimal trading and low-cost implementation. The primary objective is not to outperform the benchmark but rather to closely match its risk and return characteristics. Passive strategies generally benefit from lower management fees, lower portfolio turnover, reduced transaction costs, and greater tax efficiency. Because passive managers follow predetermined index rules, they require fewer research resources and less frequent decision-making. Passive investing is particularly attractive in highly efficient markets where consistently outperforming benchmarks through active security selection is difficult. These characteristics have contributed significantly to the growth of passive investment products globally. Active management, by contrast, seeks to outperform a benchmark through security selection, sector allocation, factor exposure adjustments, and market timing decisions. Active managers conduct extensive research and analysis to identify mispriced securities or market inefficiencies that may generate excess returns. Active approaches may be particularly valuable when markets are less efficient, benchmarks are broad and flexible, or client mandates involve specialized requirements such as ESG restrictions. However, active management introduces additional costs and risks. These include higher research expenses, greater trading costs, reputation risk arising from regulatory or ethical violations, and key person risk associated with the departure of essential investment professionals. Higher turnover may also increase tax burdens, reducing after-tax portfolio performance. Benchmark selection is a critical component of equity portfolio management because benchmarks provide the standard against which portfolio performance is evaluated. A suitable benchmark must possess three essential characteristics. It must be rules-based, transparent, and investable. Rules-based benchmarks employ objective and predictable methodologies for stock inclusion, weighting, and rebalancing. Transparency requires that benchmark construction rules be publicly available and easily understood by investors. Investability ensures that portfolio managers can realistically replicate the benchmark's return and risk characteristics. These qualities enhance credibility and facilitate meaningful performance comparisons. Without an appropriate benchmark, investors may struggle to assess whether portfolio returns reflect manager skill, market conditions, or excessive risk-taking. Selecting an appropriate benchmark requires careful consideration of desired market and risk exposures. Investors must determine whether the portfolio seeks broad market exposure or targeted exposure to specific sectors, countries, regions, market capitalizations, or investment styles. Geographic choices may include domestic, international, developed, emerging, or frontier markets. Risk factor exposures may focus on market beta, company size, value, growth, momentum, liquidity, volatility, or quality characteristics. The benchmark should closely reflect the portfolio's investment mandate and constraints while providing sufficient breadth and liquidity to support implementation. Effective benchmark selection promotes accurate performance evaluation, facilitates risk management, and ensures alignment between portfolio objectives and investment strategy. Consequently, benchmark construction remains a foundational element of successful equity portfolio management.